A hedge fund is a type of investment fund that pools capital from accredited individuals or institutional investors and employs various strategies to generate returns for its investors. Hedge funds are managed by professional fund managers and are known for their flexibility in investment approaches, including the ability to use leverage, short selling, and derivatives. Hedge funds often target high net worth individuals and institutional investors due to regulatory requirements and the potential risks involved. Here are key characteristics of hedge funds and the differences between hedge funds and mutual funds. Hedge fund characteristics. Investment strategies. Hedge funds employ a wide range of investment strategies, including long, short equity, global macro, event-driven, statistical arbitrage, and others. This flexibility allows hedge fund managers to adapt to different market conditions and seek returns in various market environments. Leverage. Hedge funds may use leverage to amplify their investment positions. This involves borrowing capital to increase the size of their investments, potentially magnifying both gains and losses. Short selling. Hedge funds have the ability to engage in short selling, which involves selling assets they do not currently own with the expectation that the asset's price will decline. This allows hedge funds to profit from falling markets. Performance fees. Hedge fund managers typically charge both a management fee and a performance fee. The management fee is a fixed percentage of assets under management, while the performance fee is a percentage of the profits generated by the fund. Accredited investors. Hedge funds often target accredited investors, such as high net worth individuals and institutional investors. Accredited investors typically have higher income or net worth thresholds and are presumed to have a higher risk tolerance. Mutual fund characteristics. Investment strategies. Mutual funds pool money from a large number of investors to invest in a diversified portfolio of stocks, bonds, or other securities. Mutual funds can have various objectives, such as growth, income, or a combination of both. Leverage and short selling. Mutual funds generally do not use leverage, and they are restricted from engaging in short selling. Mutual funds follow a long-only strategy, aiming to benefit from the appreciation of their investment holdings. Liquidity. Mutual funds typically offer daily liquidity, allowing investors to buy or sell shares on any business day at the net asset value (NAV) price. Hedge funds often have lock-up periods during which investors cannot redeem their shares, providing less frequent liquidity. Fees. Mutual funds typically charge a management fee based on a percentage of assets under management. They may also charge a sales load, which is a fee paid at the time of purchase or redemption. Regulatory oversight. Mutual funds are subject to regulatory oversight by the Securities and Exchange Commission, SEC, in the United States. Regulations include restrictions on leverage, short selling, and other riskier investment strategies. Key differences. Investment flexibility. Hedge funds have more flexibility in their investment strategies, including the ability to use derivatives, leverage, and short selling. Mutual funds generally adhere to more traditional long-only strategies. Investor requirements. Hedge funds often require investors to meet accredited investor criteria, while mutual funds are open to a broader range of investors. Liquidity. Hedge funds may have longer lock-up periods, restricting the ability of investors to redeem their shares. Mutual funds typically offer daily liquidity. Regulatory oversight. Hedge funds are subject to less regulatory oversight compared to mutual funds. Mutual funds are regulated by the SEC and must adhere to specific rules designed to protect investors. Fees. Hedge funds typically charge both management fees and performance fees, whereas mutual funds usually charge only a management fee. It's important to note that both hedge funds and mutual funds have their advantages and risks. Hedge funds are often considered more sophisticated and may offer potential for higher returns but come with higher risks and limited liquidity. Mutual funds, on the other hand, are widely accessible to retail investors, are subject to regulatory protections, and generally follow more conservative investment strategies. Investors should carefully consider their investment objectives and risk tolerance when choosing between hedge funds and mutual funds.